Before any broader discussion begins, the focus remains on the live silver price moving during the Globex overnight session, while United States stock and bond markets stay closed for Memorial Day. What unfolded after Sunday evening matched the exact market setup anticipated before trading resumed for the week. Silver futures continued trading throughout Monday as participants monitored the movement heading into Tuesday's first full United States session. The mainstream narrative framed the overnight rise as a simple reaction to optimism surrounding a possible Iran agreement. But the underlying structure driving the move was far more complex than the headlines suggested. The sequence began on Friday. A speech from a Federal Reserve governor pushed paper silver lower toward around $75. Trading algorithms interpreted the remarks as a hawkish central bank signal and immediately triggered selling pressure across paper commodities. By Saturday night, diplomatic sources independently confirmed that a framework agreement between Washington and Tehran had reached the final stage of negotiation. When futures reopened Sunday evening, silver climbed back toward the upper 70s range. The media described the move as a straightforward peace deal rally tied to commodity markets. But that explanation ignored the mechanism underneath the price action. The Federal Reserve governor who delivered the speech in Frankfurt, Germany, had previously been known as one of the strongest supporters of rate cuts within the Federal Open Market Committee. During the conference, he stated that he would now support removing the easing bias from Federal Reserve policy language entirely. He also declared that additional rate hikes could no longer be ruled out. The justification centered on the Fed's preferred inflation measure remaining at 3.8% for the sixth consecutive year above target levels. 5 independent reporting outlets confirmed the statement. Trading systems processed the message identically. Hawkish Federal Reserve language implied higher probability of rate increases, a stronger dollar, and downward pressure on paper commodities. Silver quickly fell toward around $75 as that automated response spread through the market. But the systems driving those trades could not distinguish between two completely different inflation environments. One scenario involves inflation generated by strong consumer demand inside a healthy, expanding economy. The other involves inflation caused by an energy supply shock connected to geopolitical conflict, now showing signs of possible resolution. Those are separate macroeconomic conditions. Yet on Friday, the algorithms treated them as the same. The physical market responded differently. So did the Globex overnight session. Saturday night brought confirmation from multiple diplomatic channels that a 3-phase framework between Washington and Tehran was nearing completion. Phase 1 formally ends the conflict. Phase 2 addresses the Strait of Hormuz crisis. Phase 3 launches a 30-day negotiation period covering nuclear issues and sanctions terms with the option for extension. Pakistani mediators, senior Iranian officials, and several independent reporting organizations confirmed the framework simultaneously. On Monday, the Secretary of State speaking from India described the proposal as fairly robust, while emphasizing that negotiations were still in progress. Iran's foreign ministry stated that no final deal was imminent, but acknowledged that agreement had already been reached on many major points. Those statements did not conflict with each other. They reflected a negotiation process that remained active and unresolved at the same time. The connection back to Friday's Federal Reserve comments became critical. The Fed governor referenced 3.8% inflation as justification for keeping rate hikes on the table. Independent analysis, cited by major investment banks, concluded that energy prices accounted for more than 40% of the year-over-year inflation increase. Brent crude trading above $100 was not simply another commodity headline. It was the central force sustaining the inflation pressure that pushed even the Federal Reserve's most dovish governor into hawkish language. If the Strait of Hormuz situation stabilizes and Brent crude falls from above $100 toward the $80 range, the energy-driven inflation pressure cited by the Federal Reserve could begin easing within weeks. A Federal Reserve facing declining energy inflation would not operate under the same conditions that drove paper silver toward $75 on Friday. That became the reversal mechanism. Friday's decline in paper silver originated from fears tied to energy inflation. The Iran negotiation framework represented a possible solution to that same energy inflation problem. The algorithms that sold the market on Friday did not calculate that relationship. The physical market did. The Globex overnight session reflected which side recognized the connection first. What mainstream coverage largely ignored was the mathematics inside the COMEX fault system. Media outlets focused on the Iran negotiation and the rebound in overnight futures trading. What received far less attention was the structural pressure sitting underneath the silver market ahead of First Notice Day. Registered deliverable silver within the COMEX vault system currently stands at 81.7 million troy ounces. That represents the metal immediately available for futures settlement. Total paper open interest across COMEX silver contracts sits near 57 million troy ounces. That creates paper leverage of 6.2 times. For every single troy ounce of registered deliverable silver, there are 6.2 troy ounces of paper claims attached to the system. The delivery coverage ratio now stands at 16.1%. The formal systemic stress threshold is 15%. That leaves the market only 1.1 percentage points above the recognized stress line as first notice day approaches on Wednesday, May 27, 2026. The June 2026 front-month contract still carries approximately 2845 open contracts. Together, they represent 14.2 million troy ounces of silver that must either roll forward into a later contract month or stand for physical delivery. First notice day arrives Wednesday. Memorial Day keeps United States equity markets closed Monday, but COMEX silver futures continue trading through Globex as the market moves toward the opening of the next full session. Tuesday becomes the final complete regular trading session before first notice day arrives. What major media coverage failed to recognize was the interaction between the Iran negotiation rebound and the futures delivery structure itself. As silver futures recovered from around $75 back toward the upper 70s during overnight trading, the July contract also advanced. That matters because June long positions preparing to exit must roll into July. As July strengthened against June, the premium widened. The cost of rolling positions increased. Every one of the 2845 June contracts approaching expiration suddenly faced a different calculation. Either absorb a more expensive premium to move into July after the market had already rebounded, or stand for physical delivery at a price no longer sitting near Friday's lows. The deal-related rally did not reduce delivery pressure ahead of first notice day. It intensified the cost structure for every remaining position still waiting to roll. That became the structural element largely ignored, while headlines focused only on optimism surrounding the Iran framework. Questions also emerged regarding the durability of any agreement. Several independent observers pointed out that Iranian state media had not confirmed any uranium transfer arrangement. Others highlighted that the Strait of Hormuz mines issue and the physical infrastructure damage tied to the conflict remained unresolved despite diplomatic progress. A viewer from Florida noted that ceasefire language was still being refined throughout the weekend. Those observations aligned directly with the way gold and silver traded through the volatility. The framework itself was real. 4 independent diplomatic sources, including Pakistani mediators, confirmed its existence. At the same time, negotiations remained unresolved. On Monday, the Secretary of State openly described the process as a work in progress. Questions surrounding uranium disposal timing and the reopening schedule for Hormuz remained active points of negotiation. Iran's foreign ministry contradicted several reported deal terms during the same 24-hour period in which Trump described the framework as largely negotiated. That uncertainty gap explained the divergence between gold and silver. Gold maintained structural stability because the broader macro uncertainty had not disappeared. A complete resolution would require a finalized agreement, formal certification, and implementation. Silver reacted faster to optimism surrounding the negotiations because its industrial demand profile is directly tied to the normalization of shipping through Hormuz. Both metals behaved consistently with the environment surrounding them. Institutional positioning over the previous 72 hours reinforced that interpretation. Gold remained near the $4,500 range during Friday's algorithm-driven sell-off and through Sunday's overnight rebound. When paper silver declined sharply Friday, the percentage loss in silver exceeded the decline in gold. When the Globex market rebounded Sunday night, silver advanced earlier and with more force, while gold remained comparatively stable. That divergence was not random market noise. It reflected institutional capital following its standard allocation strategy in real time.